Indian market shaved off almost 1,000 points in intraday today, now taking Nifty from the levels of 18K to straight at 17K. The fall has been difficult to arrest since US Federal Reserve hawkish stance. Now, just India can be the global, not just India can be the global market is seeing a repercussion with growing recession fears in US and Europe. Therefore, how should you tailor your strategy to maximize your profit in the volatile market? Which sectors are looking promising and which should be avoided over long haul? To discuss all of this, I'm joined by Vinit Sambre, Head-Equities, a DSP, a mutual fund. Welcome to the show. Good evening, Vinit, and happy Navratri to you. First question obviously would be, should we be bracing ourselves for more volatility in days ahead, and can we say that this festive season is going to be challenging one for Indian markets considering the more than usual hawkish tone we saw in the Fed commentary?
Yeah, hi, good evening and happy Navratri to all the viewers. I think this is very important question about the overall consumption outlook. So what we are actually seeing is that most of the the urban centers and most of the metro centers, the overall trend for consumption has been pretty okay. When you look at various categories, be it the mall consumption rate, be it the passenger cars, a lot of the categories are seeing good growth. There are a few categories which have also seen moderation, but I think we generally believe that they should also pick up. And there is one segment which is the rural market, which is sort of a bit slow right now. But overall, we believe that even that, because of the good food prices and let's say improved outlook for the ensuing Rabi season, I think that market should also sort of come back. And anyways, we anticipate government spends, are likely to sort of become more better as they are, approaching the national election 1.5 years down the line. So I believe the momentum in the markets should sort of continue. There has been some bit of discouragement because of the higher interest rates, but I think some bit of improved rates may not hurt the consumption as much as one expects, and we are hopeful of a good outlook as far as the consumption is concerned. And anyways, our view as fund house has been that we believe that over the next few years, because of our positive demographics, the consumer discretionary as a pack should sort of outperform over the next 4 to 5 years because of the rising income levels for the people generally, and rising aspiration. People want to premiumize and all of that. So I think all those things bodes well for consumption overall as a category.
The 10 years government security is at 7.2, and Nifty returns, if we talk about, is almost at 5.2%. Now, such a wide spread between the two tilts the risk reward towards debt instruments. Definitely, historically, markets return in such a situation have been muted, Vinit. So, does this mean that we need to be slightly careful, and does this demand caution? What would you say?
Yeah, I think so. When one thinks about the current valuations as well, as far as the Indian equities is concerned, and in comparison to what is happening globally and how the world markets have sort of reacted to the Fed changes which has sort of taken place. So I think there is some bit of caution which we would like to raise in the investors' mind that while we can say that we are all decoupled and it's all going to be hunky dory, but I think given the levels at which we are seeing the valuations, there is very little room for any type of error. And frankly, when the world is being so disorderly, it is not possible that we may not see some bit of the impact of that happening. So I think from the investors' viewpoint, one needs to remain cautious. One needs to not be very aggressive wherever the valuations in whatever pockets are very high, and try to look for sectors where the valuations are pretty, let's say, reasonable. There are a few pockets where the valuations are reasonable, so that some of these risks are well priced in while one is buying companies and businesses. But for the long haul, I believe that the earnings yield and the bond yield today showcases a picture in favor of the bonds as compared to equities. But I think as you stretch your imagination beyond 3 to 4 years, where the visibility of growth is going to remain pretty high, I think investors should be benefited by continuing to have their allocations to equity as well. So I would say that the best way to beat some of these issues is to stretch their time horizons in the market, and that is how one can think of generating wealth from equities.
Are you being cautious in your strategies for your funds amid lack of positive catalyst? What are you focusing on in terms of strategies and sector exposures?
Yeah, surely. I think that is what our portfolios also actually display in terms of the exposures we have. Generally, being slightly on the cautious side given the hyper valuations, and our sector exposures are, let's say, to companies and businesses where we are comfortable, or let's say the valuations look reasonable. So, be it banking, be it the agri as a segment where the stocks are not very expensive, healthcare as a category where the stocks are not expensive. Some of the consumption, while the stocks may look expensive, but there's a long runway of growth available. So within the consumer pack, we are slightly overweight on consumer discretionary. So I think there is a good focus on the valuations right now as far as the portfolios are concerned. So that even if we have to go through volatility, we are trying to build that into the current valuations for some of these names. So I think you're right. There is that cautionary approach which we sort of have as far as our portfolios are concerned.
Vinit, let's look at FPI flows as well. Now, FPIs have turned buyers since mid-July. Net inflows have been around $7 billion, but the year-to-date net outflow is still, it remains elevated at $21.5 billion. Now, FPI holding in the Indian market figure is at a multi-year low at around 17.5%. What, according to you, would happen now? Is there more room for selling from FPIs? How do you look at it? How do you understand?
See, I would say that our whatever little interactions we have with some of these foreign investors, I think they are pretty looking at India, with a very positive mindset from as far as the macroeconomy is concerned. India seemed to be actually gaining across the board, because of various things. One, the reforms which the government is actually carrying out, the manufacturing, make in India, Atmanirbhar. I mean, all of these are sort of giving out good opportunities for growth for many segments. And anyways, the turmoil which is seen globally, I think that also in some segments we are seeing some bit of opportunities opening up. For example, let's say the tile manufacturers today, they are seeing increased opportunities for export because the European players are not competitive because of the high energy prices. So likewise, I think there are some of these opportunities which are opening up in few of the segments, which also is positive. So I think FIs recognize that India has actually come at a very strong position, and the next few years could be good. But they are also conscious about the valuations, and we have seen that when valuations actually go past the reasonable levels, I mean, they also sort of tend to become slow in terms of their allocation. So I think that is something which may continue, but they would not be able to ignore the country for long enough, because in the same breath, we have seen some of the other emerging markets becoming even weaker in the current environment. And for the long-term money, which is chasing good growth and quality returns, I think India will provide them a good destination for the long term.
Vinit, how do you look at mid-cap and small-cap space right now in terms of valuations, and keeping in mind the near-term volatility along with the kind of underperformance from large caps? Now, how should one actually rebalance or redesign their portfolio?
So I would say that while we may talk of mid caps and small caps as a combination, but when we were trying to analyze the data for the last let's say more than a decade, and what we are seeing is that when we compare each of the bucket, the large cap, mid cap, and small cap, to their position in history, we are seeing that the large caps are relatively well placed and the small caps are relatively well placed as compared to their own historical parameters. Mid caps have sort of risen much more, and they are trading at a range which is at a high point as compared to their historical past. So in a way, just purely from the valuation perspective, I think the large caps and small caps probably today provide slightly much better comfort. But from the asset allocation perspective, I would say that investors need to constantly keep evaluating their risk. They should keep assessing their risk profile, and they should try to keep working on their asset allocation. Mid caps and small caps definitely need to be part of any investors overall asset allocation, because, and with a long term view, because as I mentioned, that the small and mid cap generally tend to outgrow the large caps in terms of the growth rate because of the lower size, and that actually provides a good option to outgrow the large caps with a long term view. So investors surely having good 7, 8, 10 years in mind, and willing to look for good wealth creation, mid and small caps should definitely be part of their asset allocation. And the short term investors who are thinking of 12 months and all, I think for them this category, the small and mid caps, is going to remain very risky because of the global volatility, and the volatility in these categories will remain high. So from a very near term or a 12 months perspective, I would say if someone has that perspective, one should avoid looking at the small and mid cap as a category.
Thank you so much, Vinit, for making time and guiding our investors and giving them a way of direction in terms of their portfolio planning. Thank you so much.
Thank you, Kavita. Thanks.